In this video, I'm going to talk about the differences between managerial accounting and financial accounting. Now, typically, when you take accounting in college, the first class you take is a financial accounting class, and you talk about things like the income statement, you talk about a balance sheet, you talk about journal entries, and all these things. And then when you get to managerial accounting, some of those topics might come up, particularly journal entries will come up again, but you're really looking at kind of a fundamentally different thing from financial accounting. And so I think it's important to kind of highlight some of the differences between the two types of accounting so you have a better understanding of what each is and what they're used for. So when we think about managerial accounting, there's really this emphasis on internal use of the information, the accounting numbers that you're creating. When we think about financial accounting, it's really the opposite. We're looking at external use. Okay, so financial accounting information that's produced for lenders or bondholders, people or organizations to whom the firm owes money, and then also you think about shareholders. Okay, so that you're really, you're putting together this 10K and these financial statements for these groups. There are other groups as well too. If you think about like regulators and so forth, but ultimately this is for bondholders and shareholders and regulators, all these different kind of constituents that are outside of the firm, right? Now, technically, the shareholders are owners of the firm, but I'm saying, but they're not managers. They're not actually inside the firm for the most part. We're talking about external parties. But when we think about managerial accounting, it's strictly for internal use. Firms don't typically report what their managerial accounting practices are and what their numbers are. It's just used by managers internally. And when we think about some of the other differences, we think about managerial accounting is not required, and that kind of makes sense because, again, we're using it for internal purposes. So it's really not something that's mandated. When you think about financial accounting, we are thinking about something that is required, right? The Securities Exchange Acts of 1933 and 1934 is not optional for a firm to put together a balance sheet or an income statement or these financial statements and to report and to, the firm has to be in compliance. It has to file these reports. It has to do financial accounting. And managerial accounting, when we're thinking about things like CVP analysis and some other things we'll get into, none of those things are required. So really the firm is just doing these things, doing managerial accounting because it helps the firm actually be more profitable and it has value. So you're not doing it because you're forced, you're doing it because you think it helps the firm when we're thinking about managerial accounting. Now, managerial accounting, and again, this is kind of consistent with the ideas for internal use and it's not required, it doesn't have to follow GAAP. Right, so a firm, a CEO, whatever, some organization can come out with whatever kind of managerial accounting numbers they want. They can just disregard certain types of things. They can say, we don't care about marketing expense. We can just do whatever. And that's okay because they don't have to follow GAAP. But, of course, we know that financial accounting, you have to follow GAAP. Right, it's not optional for a firm when they put together their income statement to say, you know what, maybe I don't think I want to. I want to be deducting marketing expense. No, you have to deduct that because that's GAAP. Those are generally accepted accounting principles that you have to follow when you're financially reporting, putting out your income statement and all these other statements. But for managerial accounting purposes, you don't have to follow GAAP, and you can come up with whatever kind of numbers that you feel are useful for your organization. And when we think about what these numbers are used for in terms of managerial accounting, we're looking at the future, right? We're making decisions about, okay, what is it going to cost for us to produce this number of units? What are we going to budget? What's going to be our budget for marketing expenditures next year? But when we think about financial accounting, it's really past oriented. With financial accounting, we're not saying, well, what's our budget for marketing next year? We're saying, what was our marketing expense last year or last quarter? Because that's what we're going to put together income statements and balance sheets with and then give that to these constituents here. So financial accounting is really measuring transactions and things that happened in the past, and kind of putting it together for these external parties. Whereas managerial accounting, we're kind of putting together this information internally for our managers that help us make decisions and plan and do all these things for the future. So it's really a fundamental difference when we think about the two types of accounting. And based off of that, basically, with managerial accounting, we're concerned with relevance of information. We're concerned with timeliness of information, because time is money, and we can't be waiting and saying, well, let's wait till the end of the quarter or the end of the year to see what it costs to produce these units. We need to know now, because we have customers saying, hey, I'd like to purchase something. So we need to come up with our budgets and all these things now, so that it'll help us in the future with making decisions and planning and all these things. But when we think about financial accounting, we're concerned more with objectivity, and then we can think also about not just objectivity, but precision, right? We want precise numbers, right? We're managerial accounting. We're maybe not so concerned with exactly if we get the cost down to the dollar, if we get it right. We're really more concerned with, let's get those numbers now, and let's make sure they're relevant and help us make decisions. But when we think about that financial side, remember, this is going to lenders and shareholders, and if you give imprecise information or information that's been distorted, or there's some kind of problem, the shareholders can then file a lawsuit. They can sue the firm, and so you can have all these problems if you give misleading numbers and stuff. But when it's internal purposes, we don't really have a risk of being sued, or that there's going to be a propensity for fraud or something like that. But when we get financial reporting, we've got all these different considerations that we're producing this information for the benefit of people external to the firm, and so we need to make sure it's precise, so we don't get sued or have issues with fraud or something like that. And then, now, of course, there's many different differences between managerial and financial, but I'll say the last one here that's really important is that managerial accounting, we're thinking about reporting by segment. Now, when we talk about segment, we're talking about like divisions within the firm. We could say, like, let's say the firm has an international division. Let's say they have an international division, then they have a division in the United States. Or they have a division that produces this type of part, and then a division that produces that type of part. Well, however the firm wants to slice it up, they can slice the firm up into segments or divisions. And they can go ahead and report on a segment level. And they could say, okay, so let's say we've got the firm. And then we say, okay, over here's Division A, here's Division B, and here's Division C. We can come up with an income statement for each one of these. We have like a segment income statement for Division A, for Division B, Division C, and we can determine what costs we want to allocate to those divisions. We can think about all those things and report at the segment level. But when we think about financial accounting, what we're really building, what we're really putting together for our shareholders and lenders, and we're putting together a consolidated income statement, a consolidated balance sheet, right? So we've got all the different subsidiaries or segments. We're going to ultimately put it all together into one consolidated balance sheet, income statement, statement of cash flows, and that's what we're going to report. They're not so much worried about what happened on the division or segment level, and we may not even have to report that information when we're thinking about financial accounting.